Today, I'm answering 7 questions that our viewers have asked. So if you're curious and have a question that you'd like answered, type a question in the comments below. Well, let's begin. And Elizabeth has written in and said, do banks charge an early termination fee for home loans? And this is a great question. Back in the day, there was a thing called an early establishment fee. And this was a fee that would be charged if you left the bank within 4 years. Progressively, it got lower and lower, but these fees were up to $1,200 to leave early. The good news is that these are no longer applicable, and there's no such thing as early termination fee on a variable home loan. There is a break fee, though, still applicable on a fixed rate, and it's as simple as how much are you losing the bank, and that's how much you'll be paying them. So with the fixed rate, based on 2 things, it's basically on the interest rate that you fixed in at compared to the rates at the time, and how long is left on the term. So the longer you've got left on the term and the bigger the differential between those 2 interest rates, that's to say your rate is higher than the variable rates on offer, then the higher the exit fee. So thanks, Elizabeth, for your question. The next one comes in from Samuel, and he asks, when do mortgage payments start after settlement? And this is a great question. So if you've set up monthly payments and all contracts are minimum monthly payments, you on a 30-year term, you have a minimum 360 payments that you have to make under the contract. And even if you select weekly or fortnightly, that's still the case. Your contract will always show monthly terms. So essentially, your mortgage is paid in arrears, or that's after the fact, after the month is completed. So if you settle on the 1st of the month, your payments are due on the 1st of every month thereafter. That's not to say you can't change them. It's not to say you can't change it to a fortnightly or weekly, or even the month when it's charged, but that's when your monthly payments will officially begin. So thanks, Samuel, for your question. And the next one comes in from Zoe, and she asks, how can I get a home loan with no deposit? So there's really 2 ways you can get a home loan without a deposit. That's either through a guarantor home loan or an equity loan. We'll look at the 2. So guarantor home loan, essentially, you'll ask your parents to go as guarantor. What that'll allow you to do is it'll allow you to lend against their property. You'll own the full debt. So if you are purchasing for $500,000, 80% of it will be put against your home, so $400,000 in this case, and the $100,000 will be put against your mother or father's home, or mother's and father's home. That debt is owned by you, but if you were to default, then the guarantors would inherit that portion. Now with an equity, it's exactly the same. So if you have equity in a property, so let's go back to a $500,000 scenario. Let's say you only owe $300,000. Well, to bring it up to 80%, we could release $100,000 worth of equity, and that money can be used towards the purchase of your next home. So they're the 2 ways you can purchase without a deposit. So the next question is coming from Naomi, and she's asking, what is a guarantor? Now, guarantor, there's many different forms of guarantors. So let's say you own a property with your partner, but your partner doesn't want to go on the loan. Your partner could go and become a guarantor so that you can lend against the property that's owned by you jointly. A guarantor is essentially someone that's allowing you to use their property, but not on the loan. And a guarantor home loan is very common for first home buyers, where they use their parents' homes to allow them to use the equity and leverage it so they can buy without a deposit. But guarantor home loans are also common for other things. As I said, if you own a property with your brother or your spouse and they don't want to go on the loan, then they'll become a guarantor so that you can lend accordingly. And essentially, it allows the bank to sell the property if you were to default and not pay the loan on time. So great question there, Naomi. Next one comes in from Luke, and Luke asks, do banks offer maternity leave options? And the short answer to this is yes, absolutely. By and large, what the bank will want to do is they'll want to first understand how long you'll be on maternity or even paternity leave. And paternity leave we're starting to see more and more of. And all the bank will want to see is that in that time, you've got sufficient savings to cover yourself. So the bank will complete an assessment. And let's say on their assessment, without, say, your partner's income, that it's failing at $1,000 a month. If over 12 months, you've got more than $12,000 in savings or $1,000 a month after settlement, the bank will be able to use your return to work income providing you have the saving. So most people have maternity or go on maternity leave for an extended period of time with a return to work date set. The bank can consider the income when you return to work. So yes, absolutely, the bank does have maternity and paternity leave options. So if it's something you're looking for assistance with, it's definitely something we can help with. Theo asks, is a home equity loan secured or unsecured? A home equity loan is 100% secured, and we talked about this a moment ago. Essentially, the bank will release equity from your property providing equity is available. So the bank will first order a valuation. Based on the valuation, will determine how much money you can leverage. Generally speaking, you'll want to try to stay at that 80% mark if you can. If not, mortgage insurance is still applicable and you can still look at those options. But essentially, again, back to that previous scenario where we had a $500,000 valuation, we can lend up to 80% or $400,000 without mortgage insurance. And depending on the loan you've got available will depend on how much equity you can release, but 100% it will be secured against your home. And finally, Kai asks, what is principal and interest? And a really easy way to think about principal and interest. Interest is a rental of the loan. Rental essentially means you're never paying off the mortgage. So if you're just paying interest only, you're just renting the loan back from the bank. You'll never own the loan at all. You'll never pay it off. And the principal is, think of that as a payback. So if you're paying principal and interest, you're both paying back the mortgage and paying the rental to keep the debt. So principal and interest is essentially a short way of saying paying down the debt. Interest only is renting the debt, so you're never paying it off. So they're all the questions that we've got time for today. If you have any questions, I would love to hear from you. Type in your question below. And here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a great mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. We service across Australia and don't charge a fee. So we'd love to help. Reach out, hit us up. And until next time, I'll catch you then.